Wait. Hello and welcome. Hello and welcome from Squalify. We still have some people joining in, so we'll be starting in 1 or 2 minutes. So let's wait some additional people to join. Good. For those of you joining now, we are still waiting another minute or two. I see people still joining. Good morning or good afternoon, wherever you are. Give us some few seconds and then we will start. Good. I think we should start. For some people will continue to join. So again, welcome from Squalify. Welcome from Munich, Germany. And we are very happy that you managed to join our webinar today on how to calculate better cyber insurance limits with top-down cyber risk quantification. While we have people still joining, let's have a quick poll. If we go to the next slides, and yes, let's have the first poll. So from which country are you attending the webinar? Germany, of course. Responses or so far. Germany, Switzerland, UK, France, Spain, Italy, Northern Ireland. So we see 14 responses, probably half the participants. Good. So we see here pretty good representation from Europe. Germany, Spain, Italy, Belgium, France, Switzerland. Good. You may now just remove the screen. Hello, because. Good. So let's move to the agenda. So we have a packed agenda, and hopefully this will be very relevant and interesting for you. We will be talking about the cyber insurance landscape and also the challenges when it comes to determining the right insurance limit for your prospect, for your customers. And then we will introduce the topic and show you how you can leverage a tool using cyber risk quantification to help you determine the right insurance limit. We also will have the opportunity to show you a demo of a tool. And of course, we will have enough time for Q&A. Next slide. So these are all your presenters. Just very quickly, as Squalify, we are a software provider, software solution provider, headquartered in Munich. We provide a cyber risk quantification solution. We have been roughly 1.5 years in the market. We are owned by Munich Re, which is the largest reinsurer of the world and obviously one of the top cyber reinsurers. And we will learn in the next minutes about the topic. Present agenda. Today we have a colleague from Munich Re, Benno Kroger, who's the senior cyber underwriter at Munich Re. I have my colleague Hermann Kramer, who's the founder and chief strategy officer of Squalify, and myself, I'm Asdrubal. I'm the CEO of Squalify. So again, thank you from our side for being here. And with that, I will pass over to Benno.
Okay, yeah, thanks, Asdrubal. My pleasure to be here. As Asdrubal mentioned, I'm working in the field of cyber reinsurance and insurance from Munich Re and taking care of the product as such. And I'm here to tell you a little bit about where we are in terms of cyber insurance today. There are, of course, different numbers, but and it's a lot of estimations. But last year, the estimated economic loss of cybercrime was about $8 trillion US dollar, which includes everything, the actual damage, business interruption, costs of restoration, etc., which means that the loss is 10 times higher than it was 6 years ago, and it is expected to almost double up within the next 5 years. So cybercrime as such is one of the biggest threats we are facing currently in the world, in particular when it comes to economic costs, and it's certainly something that has to be managed in one or the other way, and everybody in this round is part of this game to manage this cyber risk and navigate through this and steer it hopefully in the right direction. If we please move on to the next slide. We continuously asking our insureds, our peers, what is threatening them, what happened to them, and we see changes year over year, and we compared here our latest poll, which we did earlier this year, with the numbers from 2 years ago, and we see a continuous growing threat of ransomware. So the wave is still not over, not new to you, a little less online fraud. But if you look at on the right side, when we also not only ask what happened to you, but also what is concerning you and how much are you concerned, we still see an increase in the general awareness and concern, how people are concerned. But luckily, we also see a reduction that people are extremely concerned, which is related to other answers, that there is much more management and strategies how to address and touch the risk of cyber. And if we move on to give you a feeling of how big the cyber insurance market is today. So we had last year an overall cyber premium in the market of roughly 14 million. We expect this to be 16 million this year, growing to 29 billion US dollar in 2027. Which is how much premiums collected in the cyber market. The biggest market, of course, is North America, mainly US and Canada, of course, where it all started, the cyber product, and which is for all lines of business the biggest insurance market. But the other, in particular, Europe, are strongly growing markets, important markets for the cyber insurance, and we expect that over the years, the rest of the world and the Asia Pacific area will come to similar numbers like we see in Europe today. That's about the numbers, where we are and how big the market is. And if we go on in our slides.
Yes. Done.
Yeah. Okay. Then I would like to share some thoughts with you where the growth comes from and what we see where the cyber insurance market is today, the actual topic of this part of the presentation. So compared to other lines of business, what we call the penetration rate is extremely low in the cyber market. So penetration rate means the percentage of companies that buy insurance product. And we estimate, or have to estimate, that this is less than 5%. While in other lines of business, and we took natural catastrophics like hurricane insurance, we are above 30%. Likewise, fire insurance. So today. Another thing what is driving is that the losses are increasing, and by increasing losses, we're talking mainly about the frequency and the number of losses, while the size of the losses for the last year remains stable, and where we have an insurance, one of the driving factors that we are supporting the most is the awareness, to bring awareness of risk as such, bring awareness that there are solutions to calculate the risk, to do a risk management based on numbers, and also raise the awareness for liability that comes with the cyber risk, because we are not facing what we call first-party risks, that I get harmed or suffer something, but also that in my responsibility, I cause a damage on a third party, and therefore running into liability issues. I don't have to tell you that with the still raising digitalization and new technologies, of course, this is an entirely growing market as such. That all remains that the entire market for risk transfer in the cyber world remains the biggest growing market in the insurance world today, and is for us as Munich high efforts to remain here on top of the game and remaining the biggest insurer in this space. Next slide, please.
It's next slide. When the probably your video, because your voice is breaking sometimes.
Okay.
Maybe deactivate your video just to make sure your voice is well received.
Yeah, hopefully that works. An outlook for us in the cyber insurance industry is we want to find solutions to address the currently uninsured market and close the gap, which means we have to carefully think of what are the topics why companies are not buying insurance yet. But we also have to make the product vital or keep it vital. And therefore, that's always the biggest concern in every line of business. We have to control the systemic risks. And by systemic risks, we mean something like a cyber war or a wide outage of the internet caused by a cyber attack, which would cause many companies to fail, and therefore it's not insurable because no insurer in the world could pay for that. But to make that decision and to decide what is insurable and what is not insurable, we have to very carefully understand those systemic risks, calculate them in the right way, and build models to allow us to estimate the size of such systemic risks. And even those risks are not insured or cannot be insured, are not part of insurance. Here with Squalify, we are in a position that we can, as we are not moving in the insurance world, but we are in a risk quantification world, we can use these models that we are building and maintaining to put the numbers against it and allow companies that are using the Squalify model to understand what is their size in a systemic risk. Okay, yeah, and then last slide, what is our strategy going forward? So most important for us, we must keep our capacity sustainable, which means the entire market can only work if the size of the collected premium is bigger than the size of the paid claims. This is like in every insurance field, because if we do not take care of this, insurer will go away and not provide insurance anymore. And so it is very important for us to understand it in the right way, do the right math, proceed the right data, and have a model. And luckily, we meanwhile have almost 20 years of experience with that model to calculate it. We know the efforts to maintain it and keep it up to speed with the continuous evolving threat landscape, but it's our top priority. And in order to do that, we have a high level of cyber expertise in-house that we develop, and we buy cyber expertise with partners and companies to get the best information available. Where the same applies for data. We're maintaining, as the largest carrier, of course, also the largest database of cyber losses and cyber incidents. But we're also buying tons of data, almost every meaningful data available to to analyze it and feed it into our model to be continuously the provider of the largest and biggest cyber model in the cyber insurance world. I spoke already about systemic risk that we have to maintain, and with that, I hopefully gave you a basic understanding where Munich Re is in terms of the cyber strategy of the cyber product we are offering and the model we're maintaining to quantify cyber risks.
Thanks, Benno, for that. Benno will stay also until the end. So we have a Q&A section at the end. And as I wrote in the chat, please feel free to post, write any question. There's a Q&A button next to the chats in your Teams window at the top. And we will go through all the questions towards the end. So now moving on, I think passing over to Herman, we'll continue.
Yes, so after Benno has set the scene, now coming closer to the topic of this webinar, why it is so difficult to determine the right insurance limit. And then the overall answer is because the original risk is unknown or not completely known. And so talk about original risk. And here on the left-hand side, you see the dark blue area. I plotted here the original risk in 2 dimensions. One is the scope of the risk, what are types of losses coming out of cyber incidents. And then on the y-axis, the size of risk. There are different sizes. So both together poses the original risk. And you see here on the top, really nobody can know what is the absolute maximum amount, because there are quite a lot of unknowns in cyber risk, and probably we have not seen the largest as well. But within that known area of the original risk, insurers put here in cyber insurance, which is here more the yellow piece. And for that, they also need to determine for that insurance, cyber insurance, a limit. What is the absolute limit the insurer will provide if an original risk, an incident occurs? And normally they have a deductible, so both are limitations, but also from the scope, an insurance is not covering everything of the original risk. There are exclusions and or sublimits for special qualities. So therefore also the insurance risk is in this visualization also a little bit narrower than the original risk. So that is how the situation is. And most of you know about, because you are in the insurance and reinsurance broker area, and therefore this is the first understanding of why it is so difficult to determine the right limit. So how normally people are dealing with selecting the risk here, and there are different pragmatic approaches. If the people do not know the original risk, the size and the scope of the original risk, they do peer benchmarking. Especially brokers and also larger brokers have a ton of historic databases about peers, other companies who have bought cyber insurance, and they can do a benchmarking, trying to find comparable companies and find out what were their average, their smallest and biggest amount, what they have bought as limit. This is kind of peer benchmarking. The second approach is normally companies have a certain kind of budget for cyber insurance. And then they are just buying as much limit as they can afford with this budget. Sometimes they are task a broker or do it by themselves, but just this is then limiting the amount of coverage or the amount of limit they are buying. A very specific way of this is then also a mixture of both, is the layered tower approach. Nowadays, larger companies buying limits up to 500, sometimes more million of dollars, and they put it into slices, into layers. And this is now what I have shown here to be a little bit more specific, how large organizations are dealing with an insurance program with different layers. So here you on the right-hand side see how the insured risk now is placed in the insurance market. They have different layers. For example, the primary layer is a layer of 40 million above a self-insured retention of 10 million. So all losses within 10 million are self-insured and not insured. So the first insured layers are in the primary insurer, insurer A, and then going up and up. So the higher the layer, the less exposed they are. And depending on different risk appetite, different insurers are offering different pieces of different layers. And that is then very often the task of a broker to bring all these different insurers together to fill all the layers. And sometimes what you see here, there are also gaps here in the dark blue area where such a program can't be filled completely. But this is a typical situation how a cyber insurance program, a large program, are placed in the insurance market by different players and insurers. So here now, based on that information and preparation, the second poll. Which of these methods do you currently use to calculate insurance limits? Peer benchmarking, budget-based approach, layered tower approach, or any other approach? Okay, based on these 10 responses, we see fairly distributed. Yeah, I would be curious about the others, but the most selected one is budget-based approach. Yeah, then peer benchmarking, and third is layered tower approach. Okay, thank you for that feedback. Yes, so what's the issue here with these current methods? Yeah, so peer benchmarking is a valid approach, but of course, what you see here is that you are part of your peers, yeah, and nobody knows whether your company is really reflecting with all its specifics with the peer group, whether you are really also covered with this. And the other topic is within this peer group whether this limits what they have bought on average is sufficient, because this is part of different common approaches and what the people have bought probably also by market demands. So here peer benchmarking is not really reflecting whether here the company is really buying enough compared to its individual risk transfer demand. The budget-based approach, yes, it very much depends then on the market situation. In a so-called hard market, when the insurance prices are high, you can buy so much limit. And in a soft market, you can buy more. And so therefore, your limit is then determined by the market situation and not by the real demand of the original risk of your company. And also, as I've shown here, the layered tower approach may lead to gaps because it's always difficult to find all the coverage, especially for large companies. And you have some other issues here also, whether you have always say capacity, security of insurers covering these large towers. So therefore, there are many limitations in these current approaches. And the biggest reason here is that here the original risk is not fully known or totally unknown. And that is now what we need to address. And that is why we think, we need cyber risk quantification to really determine the original risk as a precondition for the right selection of insurance limit. And this is what I want to show to you in the next slides. Here we have a poll again. So is your company already using cyber risk quantification? Yes, no, we are thinking about it, or don't know. Okay.
Less than half, yes.
Okay. Yeah, 1/3, yes. That's really good, and shows here also some really advanced companies. No risk quantification. This is not bad because there are many companies not using risk quantification yet. So what is it all about? Risk quantification, cyber risk quantification, CRQ, is based on the basic principle that you only can manage what you can measure. Yeah. So if you can measure risk, then you can do also professional risk management. And so understanding your overall risk posture is a precondition for professional risk management. And many of you will know that there are different strategies in risk management. So you can avoid risk, you can accept risk, you can mitigate risk, or you do risk transfer. And we are talking about insurance, so risk transfer is now the question, and the focus on why cyber risk quantification is a good method to select the right limit for insurance. But it all depends on which kind of approach you use for cyber risk quantification. If you look into what currently is the mostly used, we call them all bottom-up cyber risk quantification approaches. Bottom-up means you start with basic assets, information assets, business processes, and put a risk label, a risk extent, and a probability on each of these assets. And then you try to aggregate all these assets to a company level. And this is complex. You need a lot of data, which are hardly available and very resource intensive. And therefore, the quality of the output is not that really good that it really helps you on the strategic overarching company level to do strategic decision making with bottom-up approaches. Instead, top-down starts at the company level. Yeah, and it's really therefore also good for strategic decision making. So therefore, it does not need that many data input and that many differentiated information on the asset basis. It starts on the aggregated level with data, and therefore the risk quantification process is very lean and fast. And this is what we are using at Squalify. We are from the thinking, from the approach, very much based on the insurance thinking. Like insurer, also think about calculating the risk, the premium for the whole company, and not only for different assets. So that is the same thinking what we are using here for calculating the original risk. So what we are using here in the demo is that we really focus on the company-specific expected cyber losses, and not for an industry average. We can do also some benchmarking, but it's very important that we have on the company level or the aggregated company level here the aggregated view. We also think like insurers to differentiate the exposure from the protection level. And this is a way to have an economic view and show you whether you are over and or under protected. And then what we do is at the end, we calculate the value at risk. So after a Monte Carlo simulation, here risk extent, exposure in euros and dollars, which we then can also differentiate by the most important risk types. We call it consequence scenarios, because as an insurer, you also think only in consequences. Normally, you do not know all the causes of loss, but you are responsible to cover what are the financial consequences of the cyber incident. And here we can differentiate between business interruption, data privacy breach, financial theft and fraud, and digital liability. So therefore, it's important to see how we are doing it. Yeah? So what we as Squalify using is the same underlying cyber risk quantification model of Munich Re. Benno have shown you how much effort and how much strategic importance Munich Re has in calculating the right cyber insurance premiums and to be sustainable and here successful in cyber insurance. We are using the same underlying methodology, not quantifying this premium, but the original risk. On the way to come up with the premium, this is a four-step approach, and we stop at the third level where the original cover is calculated, the original risk is calculated, and then the coverage is then a filter on the original risk, and this layer, the fourth layer, is skipped. But this is then also only the scope of insurance. So what we did in addition is we extended the scope of our model beyond what is insured. So for example, we have added here a module also to include financial theft and fraud or other here special risk, which are typically not insured in any instance. So we are using a lot of data, as Benno has said, and we have used this quantification approach for large organizations already for more than 4,500 big corporates. So therefore, with this quick and lean data input, which I will show you, we can do a quick assessment within 2 days or a full cyber risk quantification within days and not weeks or months with the current most used bottom-up approaches. Good. So therefore, now I will come to show you what we do and how we quantify the original risk in our platform with a live demo. Yeah. So here you see now our tool. It's a web application, and for we can do a lot of different use cases. But for today, I will focus on what is needed here for insurance limit calculations. So we have a two-step approach here. First, basic exposure data, company, and then information security, maturity information. These are the two steps. And here you can, on the data entry part for company information, very basic information, and most of you are very familiar with, because these are information you also ask in an insurance questionnaire. So it's a headquarter of the company, the industry. We can here differentiate by 130 sub-industries. Here we have here a machinery manufacturer with 2 billion of revenues, and the gross profit is 300 million. They have 10,000 employees, B2B customers, suppliers 10,000. And then here's some more specific company information about personal identifiable information, 1 million, PCI, subset here. And then also revenue distribution, which is also very common in insurance questionnaires. The differentiation between EU, which is here predominant 90%, but also US and other notification countries. So that's it. That is the basic company information. And then if you go back in the second chapter, here are the information security maturity information captured. So it's all about how the company is protected against cyber incidents. And here we have the opportunity, because here we are working with the NIST, but controls of more than 100, but the top 28 are the most important ones. And already with 28 controls, which you can select here with different levels, yeah, it's very similar what an insurer are doing here with the risk assessment on the quality side. You can enter 28 8 different controls here. And then if you store them and calculate, you get here a report. And we have a lot of metrics based on that. Yeah, here the worst case is, here are numbers which are derived from the understanding that what can happen if almost all controls fail. So what is the exposure independent how the company is protected? We show that here the worst case also by 7 loss components, and you see here also, because business interruption is the highest one, the most driver for business interruption is loss of profit and so forth, but also breach, cyber extortion, regulated defense costs are all broken down. But the most important piece here for the limit determination is a modeled large loss. If you take into account how the company is protected, then you have different probabilities which kind of extend the expected loss will come. So this is a kind of value at risk. And here we show 4 different probabilities with different expected losses. So the 100-year loss is a 1% probability, and with a 1% probability, this company will have an expected loss of nearly 68 million. And you see then the more seldom a risk is, for example, a 500-year, 0.2% probability, the status quo is 118 million. So the less probable, the higher the expected loss is. And from this kind of thinking, you can determine which is your risk appetite. When you think about, okay, if something goes beyond and below a probability of 1%, I do not care. I only want to cover what is here within this 1%. Then I should buy something around this expected loss of 68 million. So it could be 50 million if not everything is covered, or 75 million. So that could be a good limit, insurance limit here, which would cover here most of the original risk. So, but if the company is more risk adverse, it should, for example, also want to protect something where the probability is at 0.1%, so the 1,000-year recurrence period, then they should buy something about 140 million. This is the kind of thinking which we can help the company to determine which could be the best limit which fits to the risk appetite of the company. We have many other things. We can show the modeled average loss here, yeah, and also here how the company is over or underestimated by different risk profiles. Also show here what is a top 10 list of controls which could improve the numbers to reduce them, but these are not that relevant for the question, but show here that our tool is much more also stronger for other use cases than just the insurance limit. But that's the demo. Okay, so
Right.
from that,
Yeah, let's before we go to the Q&A, just to summarize the key takeaways. So we learned from Ministry, from Benno, how big is the gap when it comes to cyber insurance. You saw also a very low penetration rate compared to other more established insurance sectors, areas like national catastrophe. So there's a huge potential for brokers to tap into that and help your prospect and customers. Herman just showed us how a lean top-down cyber risk quantification can be used to determine appropriate cyber insurance limits, so really helping to understand and coming closer to that original risk and have a better insurance coverage for your prospects and customers. And of course, in a broader aspect, how a top-down cyber risk quantification can enable your prospects and customers to understand the business impact of a cyber attack. I mean, the executives and the leaders of those companies They are not IT people. They don't care much about the technicalities, but they want to understand what is the business impact. And if they understand that, then they will be very keen and ready to invest in cyber insurance as part of the cybersecurity defense. So that's the key takeaways. And let's now move to the Q&A section. We have 15 minutes. You can post questions in the Q&A section. There was already a question in the chat. I don't know if everyone saw it, but someone was asking on which InfoSec framework the maturity is assessed. So the one shown in the tool was NIST version 2, which is a pretty complete, pretty comprehensive. But obviously, we can also map other InfoSec frameworks. But remember, you don't need to have answers for all those controls. You don't need to assess all those controls. I mean, this is you will be doing only a lean and a minimum quantification in order to get a good value for the coverage of the insurance. Herman was talking about top 28, but maybe it's only top 20. It really depends. So we open now the grounds for any questions, or just post it in the Q&A section on the Teams tool. Feel free to speak up if you want to. We see first question. Is it possible input a mix of industries if the client is a heterogeneous corporation?
Yes, there are different means to work with this. Yeah, this is a very typical situation where a company has different sub-industries with one conglomerate. Yeah. What insurers normally do, they take one of the most dominant industry and dominant in respect of cyber exposure and calculate with this one. If we want to have here a more specific one, then we split the company in calculation into the different industries and calculate here for each of the sub domains or sub entities of this conglomerate, separate risk quantification, and then aggregate them here on a higher level. But normally here, for most companies, it's sufficient that here we take the most dominant one, because at the end, most of the companies are not very homogeneous. And even though, yeah, for example, if you're a car manufacturer, all of them have a financial services department, which is typical. So it's not necessary to have a separate calculation. Yeah, because all the data which are behind the model are included in this main industry of auto manufacture.
I hope that answered the question. There's another question that came through the chat. I understand you're a consulting firm. What type of client you're looking for? What is the size of prospect for your consultant you want? Yes, I mean, we are a product company, so we are not a consulting company. So we provide a software. You saw the tool is a platform. And of course, we provide consulting when it comes to implementing and making sure the tool is being used in the right way. The tool can be consumed by direct customers, so for many industry, financial, manufacturing, when they want to quantify the cyber risk. But we are also talking and see insurance brokers as potential use of the tool, because they want to determine the right coverage for the clients. They can become more relevant. They can help the clients to understand the cyber exposure, as opposed of giving a number and not understanding why the insurance limit was set at that level. So as a matter of fact, we are engaged with brokers that are very interested in using and doing a lean quantification to understand the value at risk and have a proper coverage for the clients and add more value as a service to the clients. So we can engage with brokers as clients. We can also engage with clients of different sizes in different industries.
Good.
No more questions? Still have some time. I'll go to the last slide. Yes, there. Okay, so if there's no further questions, we give you back some time in your calendar. You know where to find us. So if you will be interested in going deeper or have additional questions, please come back to us. You can visit our website or you can just drop us an email. Thanks a lot and have a great rest of the day.
Bye-bye.
Goodbye.